The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic Enterprise. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. Introduction to Personal Investing. This is the first video in a two-part series. This video will focus on determining your investment objectives, understanding the risk-return trade-off, and learning about the various investment strategies. Determine your investment objectives. Your financial goals keep you focused on your investment journey. They help you determine your investment objectives, and this will then guide you on choosing suitable investments. Here are the three basic investment objectives: growth, income, and security. Growth. If growth is your objective, your portfolio will have an emphasis on equities as there is potential capital appreciation as well as dividends. Returns will potentially be higher, but so will the risks. If income is your objective, your portfolio will be more focused on fixed income instruments. Returns are medium to high, and so are the risks. Possible investments include bonds and dividend-paying securities. If security is your objective, your portfolio will focus on capital protection. The main investments would be safe and are therefore low risk. For example, higher grade bonds. Now, what is investment horizon? Investment horizon is the amount of time you have to invest to achieve your financial goals. If you are in your early 20s and have just started working, you have a long investment horizon ahead of you and can potentially take on greater risk. However, if you are older, close to retirement, or already retired, your investment horizon is short, and you should not take on too much risk. Start investing early so you have more time to achieve your financial goals. When you are young and have just started work, you are in the accumulation phase, and because your investment horizon is long, your objective can be growth. As such, you can take on more risk, but only if this fits your risk profile. As you grow older and move into the pre-retirement phase, your emphasis should start to shift gradually from growth to income, and you should try to reduce your risk exposure. And when you are finally in the retirement phase, you will naturally have a short investment horizon, and you will look to conserve assets and protect capital. Your priority should be income and security. Whichever phase you are in, it is very important to understand that all investments come with risk, the only difference being the level of risk. In the next section, we'll look at the risk-return trade-off. Understanding the risk-return trade-off. Actual return from an investment may be less than what you expected because of risk. It's important to remember that higher risk does not necessarily equate to higher returns. Risk can be broken down into market and specific risk. Market risk refers to factors that affect the entire market, such as the global financial crisis or the COVID-19 pandemic. Specific risk refers to events that affect only that company or industry. For example, a plunge in oil prices, which would then badly affect the oil and gas sector. Return on investment is the gain or loss made on your investment when you sell. Total return equals income plus capital gain or minus the loss. Net return equals total returns minus costs. Costs would be transaction costs which are paid by you directly, such as brokers' commissions. For unit trusts, costs will include front-end sales charges, back-end redemption charges, switching fees, and the expense ratio, which is made up of fund management, trustee, and custodian fees. Risk and return trade-off. Investments that have potentially higher returns will have higher risk of losing all or part of the capital. It is very important that you know your risk capacity and risk tolerance as they form your risk profile. Risk capacity is your financial ability to take risk. Risk tolerance is your emotional willingness to take risk. Risk capacity and risk tolerance can be influenced by many factors. For instance, your investment horizon. Do you have time to recover losses if markets plunge or if you incur losses on your portfolio? Your capital. How much can you afford to lose? Your commitments. What are your current and future commitments? Do you still have debts such as a housing loan? Your dependents. How many dependents do you have? And if you have children, have you saved enough for their education? If you want higher returns, you must accept greater risks. However, taking on more risk does not guarantee higher returns. In the next section, we'll look at 3 investment strategies that can help reduce risk and possibly increase return. Investment strategies. The first investment strategy is diversification, which is about mixing a variety of investments in your portfolio to reduce risk. As the saying goes, don't put all your eggs in one basket. You can diversify your portfolio across different asset classes like shares and bonds, different markets like domestic, regional, or global markets, or across different sectors and industries. Assets that move together in the same direction are said to be positively correlated. One way to diversify is to combine assets which move randomly or in opposite directions. These assets can be described as being negatively correlated or even not correlated at all. Thus, investing in assets that have low correlation or are not correlated is beneficial because they are not impacted by the same market trends. Hence, shocks in one market will not affect the others as much. The second investment strategy is known as asset allocation. It attempts to balance risk versus return by adjusting the percentage of each asset in an investment portfolio according to the investor's risk profile, goals, and investment timeframe. How much to allocate to each asset class is important, as studies have shown that over 90% of your returns are determined by your asset allocation decisions. Here are some factors to consider when deciding on your asset allocation. Risk profile, current and expected market conditions, investment horizon, investment objectives, asset mix depending on expected rates of return for each asset class. The third investment strategy, known as dollar cost averaging, involves investing equal amounts of money regularly over a period of time. Let's say you decide to invest $100 every month. In the first month, if the price of the asset is $10, you buy 10 units. In the second month, the price goes up to $12. You buy another 8 units. And if the price goes down to $9 in the third month, you buy 11 units. Although the asset's average price over the 3 months is $10.33, your average price is lower at $10.20 because you bought fewer units when the price was high and more when the price was lower. This strategy will help you achieve lower unit purchase costs even in uncertain market conditions. However, bear in mind that transaction costs can have an impact on your investment returns. Market timing is not a legitimate investment strategy. It involves moving your money in and out of markets to attempt to benefit from the upside during bull markets and the downside during bear markets. It is hard to make a significant return on a sustainable basis using this technique because trying to time the market is very difficult. It adds to investment risk. It fails to make a consistent positive impact on your portfolio. Time in the market is more important than market timing. It is more important to stay invested than it is to trade regularly. Other strategic considerations that could affect your investments are taxes, liquidity, laws and regulations, and unique circumstances. By unique circumstances, we mean whether you are comfortable investing in certain sectors. For example, those dealing in alcohol, tobacco, and gambling. Here are the key takeaways. Always be clear about your investment objectives and your ability to withstand risk and losses. Do not put your money into investment products that you do not understand. Allocate your funds according to your investment objectives and risk profile. A diversified portfolio can help you better withstand the fluctuations of economic and market conditions and cycles. Regularly review your investment portfolio.